Warren Buffett is widely considered the world's most successful investor, with a diverse portfolio spanning finance, insurance, construction, and manufacturing. When it comes to real estate, he once famously stated he would purchase tens of thousands of single-family homes if he could. Yet surprisingly, at the beginning of this year, he decided to sell his entire real estate empire, one he's held for over 2 decades, in a single package deal. Even more shocking, during the recent shareholders meeting, he publicly declared that real estate is significantly inferior to stocks as an investment. This raises the question, has America's golden age of real estate truly ended as many suggest? But if that's the case, why would Buffett also mention that his longtime partner, Charlie Munger, actually became increasingly interested in real estate in his later years, continuously expanding his property investments? So what's the real story? Is American real estate now just a headache to deal with, or does it remain a solid asset that preserves value over time? Let's explore Buffett's complete reversal on real estate and consider whether we ordinary investors need to rethink our own financial strategies. Before diving in, if you're finding this valuable, please hit that like button and subscribe to my channel. Your support genuinely motivates me to keep creating content for you. Buffett's shift wasn't sudden. The signs were already there back in March when America's largest real estate brokerage, Compass, moved to acquire Buffett's Home Services. This company, which Buffett purchased over 20 years ago, oversees more than 800 directly operated real estate brokerages across America's prime residential markets. If you've ever looked at those beautiful renovated beachfront properties in California, chances are the agent showing them works for one of Buffett's companies. For over a decade, his strategy with this real estate business has been straightforward: avoid expansion, minimize complications, hold long-term, and grow steadily. But now he's changed course completely. His decision to sell is truly remarkable. This is Warren Buffett we're talking about. The man who famously holds onto his Coca-Cola and Apple investments virtually forever has decided to exit real estate. What's driving this unusual move? Based on his comments at the shareholders meeting, there are two main reasons. First, real estate transactions in the US have nosedived. The combination of sky-high home prices and rising interest rates has severely limited what average American families can afford. These interest rates have particularly spooked potential buyers who might otherwise have entered the market. Second, AI and technology are disrupting traditional real estate business models. We covered this in a previous episode about how Redfin and Rocket's merger is creating a platform using AI for property valuation, automated pricing, and one-click transactions, essentially cutting out middlemen and redirecting profit flows. Meanwhile, Buffett's Home Services remains largely a traditional brick-and-mortar operation, gradually losing market share and profits to these tech-savvy competitors. Beyond these official reasons, I'd like to add some personal observations from my experience in the field. Feel free to share your own thoughts too. Working in property development means I see these market dynamics firsthand. Recently, I've been checking out several oceanfront renovation projects where investors are combining multiple properties for development. Interestingly, all these deals are being brokered by Buffett's local real estate agents. These oceanfront investments offer excellent returns, and from what I can tell, Buffett's real estate business still attracts plenty of clients. So I don't think Buffett is selling because the business is unprofitable. Rather, it's likely more pragmatic. He's 94 and preparing for retirement. For someone in his position, real estate isn't about whether it makes money, but how efficiently it does so. And let's face it, real estate transactions are nowhere near as quick and clean as stock trades. Plus, he's thinking about succession planning. Handing over a leaner, more attractive balance sheet to his successor creates a much more favorable transition. So his rush to divest the real estate division makes perfect sense in that context. This situation offers us regular folks an important lesson. At the shareholders meeting, an investor who identified himself as Chinese but now living in Canada asked point blank, "Is real estate still worth investing in?" Talk about cutting to the chase. While Buffett seemed pessimistic, his partner Charlie Munger had already offered a different perspective. Charlie Munger wasn't just Buffett's business partner, but his lifelong friend. Buffett himself has called Munger his spiritual mentor in investing. Yet when it came to real estate, they couldn't have been more different, with completely opposite outlooks on property's future. Buffett is all about efficiency. If any part of his business drags down overall returns, he'll cut it loose without sentimentality, exactly what we're seeing with his real estate holdings. He'll sell what needs selling and clear what needs clearing. Munger took the complete opposite approach. He consistently emphasized that residential real estate, specifically residential, not commercial or industrial, is one of the most accessible investments for average people. The market information is transparent, and it's relatively easy to understand and get started with. This comes down to their different investment personalities. In his later years, Munger shared an interesting perspective. He believed our world is becoming increasingly unpredictable, especially as the AI revolution began. Tech companies can skyrocket or crash overnight, as recent stock market volatility has shown. In his 90s, Munger simply didn't have the energy to constantly monitor financial reports or track market news. He preferred the relative stability of physical assets. What makes real estate stable? Simple. Land doesn't have legs. It can't run away. We've previously discussed 3 key factors for analyzing real estate: population trends for long-term value, policy changes for medium-term impact, and interest rates for short-term fluctuations. All this data is readily available and straightforward to interpret. Moreover, Munger wasn't solely focused on profits from real estate. He valued quality properties as assets that generate reliable cash flow and can be passed down to children. Many of my female friends strongly support this view. Why? They bring a different perspective to what owning property really means. For instance, I have a classmate in Virginia who relocated from California to work in DC, where housing costs are prohibitive. She lives in Virginia and often says something most men might not fully appreciate. As a mother of 2 sons, she works incredibly hard specifically to ensure she can provide each of them with a home in America. Whether her sons choose to marry or have children is entirely their choice, but as their mother, she considers it her responsibility to prepare homes for them. She worries they might struggle to find partners without this foundation. You heard that right, and she's not alone. Many mothers share Munger's thinking about legacy planning, preferring tangible assets that offer stability, growth potential, and can be passed down through generations. So, if your investment temperament aligns with Munger's, or if you're interested in building generational wealth through long-term property holdings, how should you respond to Buffett's pessimism about the American real estate market? If you've purchased property or spoken with real estate investors, you'll understand why Buffett finds American real estate frustrating. The investment efficiency is abysmal. Based on my project experience, here's why, and please add your insights. First, real estate is probably the least liquid major asset class. The house hunting process alone is exhausting, driving around endlessly, possibly never finding exactly what you want. If you're not a professional, home inspections are nerve-wracking because you lack the expertise to spot potential issues. Once you own the property, rental management brings countless unexpected problems. Midnight calls about clogged toilets, summer air conditioning failures, or sudden roof leaks during rainstorms. You're dealing with both technical problems and people problems simultaneously. Compare this with stocks, where you can execute a trade in seconds from your phone. Seeing a potential market crash? A few taps and you've protected your investment. With real estate, that's impossible. Your property sits there whether you're paying attention or not. Second, real estate varies dramatically by location. It's fundamentally non-standardized. People often comment, "Those beachfront properties you talk about sell instantly, but why can't I move my house?" Or, "Schools near me have parents fighting for spots." Both observations are valid because that's real estate's nature. Even houses at opposite ends of the same street can have totally different market values. This regional variation is precisely what frustrates Buffett and makes real estate challenging. The experience you gain with one property in one area might be completely irrelevant in another neighborhood, city, or state. Standardizing and scaling your investment approach becomes nearly impossible. From a developer's perspective, here's my honest advice about who should probably avoid real estate investing. First, anyone carrying significant debt. Real estate is a long-term commitment, typically at least 10 years. If your investment cash flow dries up midway, it can seriously impact both your career and quality of life. Second, those without professional knowledge who are unwilling to learn or seek help. I understand the hesitation. Many people comment that they've been burned by brokers before and want to handle everything themselves. But if you say, I don't have your construction background or development experience, remember that Charlie Munger wasn't an architect or builder either, yet he continued learning well into his 90s. The ability to learn is the minimum requirement for real estate success. If you're busy with your career and lack time to become a property expert, that's completely understandable. Let me suggest 3 steady approaches to real estate that might work for you. Is there a way to ease into real estate while avoiding Buffett's concerns and following Munger's stable approach? Based on consultations with many clients, I've identified 3 strategies perfectly suited for ordinary families just starting out. These approaches work especially well if you're purchasing your first home. First, when buying your primary residence, focus on lot size. I've noticed newer developments continue shrinking yard sizes. When land is limited, so are your opportunities for future appreciation or creative cash flow generation. For example, a smart young couple in the Bay Area consulted with me about a property they were considering. They quickly grasped the concept. The older home they were buying had substantial yard space where they could add an accessory dwelling unit for rental income. This creates additional revenue without requiring a separate investment property. Many clever homeowners live in the main house while renting their ADU to Silicon Valley summer interns for $2,000 plus monthly. A small bedroom requires minimal maintenance costs. My second suggestion involves small investment properties with management potential. This works well for those with limited budgets who enjoy research. You might live in Los Angeles or Orange County while investing in smaller surrounding cities. As speculative investors retreat from the market, quality properties are becoming available at better prices. One critical point: never purchase investment property sight unseen. I've had multiple clients tell me, I live too far away and work too much to visit. Whether they're in New York or Atlanta looking at properties elsewhere, online listings always look fantastic until you see them in person. If you truly cannot visit personally, at least establish a relationship with local property managers or agents beforehand. Even after reviewing countless projects and properties, I would never approve a purchase with 100% confidence without seeing it myself. No matter the distance, I always fly out for an in-person inspection. Property investments represent significant capital. Caution must come first. My third recommendation is for those who already own their primary residence and want to eventually transition it into an investment asset. This is particularly relevant for young families planning gradually. When purchasing your first home, choose one with renovation potential. After a few years as your income grows, you might relocate to a different city or larger home. Instead of selling, convert your first residence into a rental property, generating steady income. This approach delivers exactly what Munger appreciated about tangible assets, reliable income generation. It also saves you from starting from scratch with a separate investment property, avoiding additional research and financing complexities. For families new to real estate investing, Munger's methodology makes perfect sense. It doesn't depend on short-term appreciation for success. Remember, as long as you're not speculating on quick profits, you won't get trapped by market fluctuations. Focus on making a solid choice for your first home, and that property can eventually become a powerful investment asset. Both Buffett and Munger developed distinct investment philosophies, but with real estate, only genuine appreciation for the asset class can carry you through market cycles to long-term growth. On a personal note, I feel somewhat melancholic about Buffett's retirement announcement. My foundation in investment principles largely came from discovering Buffett and Munger's books and videos in the university library. I must acknowledge that Buffett's assessment of the current American real estate market is objectively accurate. Working at the front lines of development, securing land, initiating projects, obtaining permits, I can confirm his market concerns are entirely valid. From my heart, I'll share my perspective. Many people wish we could return to pre-2019 conditions, with healthy supply-demand balance and a booming real estate market where nearly any purchase appreciated. That era has likely ended. Buffett doesn't see near-term hope for real estate, which explains his exit. If someone with his insight can't spot opportunities, what more can we say? We can only wait patiently. Yet I deeply respect Munger's view of tangible assets and their long-term value. I personally believe in holding for the long term. Friends often comment that they can sense my genuine passion for buildings and architecture through these videos. That's absolutely true. Architecture is my professional background and personal passion. I don't view properties purely as financial instruments. Instead, I evaluate them objectively through development, planning, and design lenses. This perspective allows you to remain composed while growing alongside the market. I sincerely wish success to everyone who truly appreciates their investments and commits to growing with them over time. If you're focused on professional investing, trust Buffett's market analysis regarding liquidity issues and current challenges. But if you're not 90 years old or planning imminent retirement, there's no reason for anxiety. Taking life day by day without rushing seems like the wisest approach. For instance, I visited some development sites today. And yes, the market is genuinely tough right now. But that didn't stop me from coming straight from the construction site, still in my work clothes, to enthusiastically share these thoughts with you. Creating this content brings me genuine joy. Thank you sincerely for your likes and subscriptions. Don't forget to hit the notification bell so you won't miss our next discussion.